What's up, traders and investors? In my past videos on Best of Us Investors channel, I have promised to share with you one of my favorite analytical techniques for stocks, which is sector rotation. What does sector rotation mean to me? To me, it is a theory that certain stocks of certain sectors will perform, either outperform or underperform the broader market at different points in the market cycle. In other words, when you have a market bottom, certain sectors will lead out of that bottom, and then at market tops, other sectors will lead while others lag. And this is important because if we understand these sector rotations, we can begin to predict where the money is going to flow from one sector to another. And we can make our investments based on this theory to get a little bit of extra performance out of sectors that we already may want to buy at different points in the market cycle. A lot of my education that I'm going to share today is more broadly explained in this book series, Trading with Intermarket Analysis by John J. Murphy. I don't get anything to say that. That is just the book series that I would recommend to study this topic in more detail. This video is going to give a very high level view of what it is, where I think we are right now, because that might help us all make better decisions going into the next few quarters where the money may be flowing. So that's what I'm going to help you out with in this video. Now, let's start looking at some examples. So, we're looking at TradingView right now, and these lines are relative performances of the SPY, the S&P 500 ETF broadly, which is the shaded area. And each of these lines, these color lines, represent one of the spider ETFs, the XLY, the XLC, the XLK. The green line we see outperforming everything else is no surprise. That is XLE for the energy sector. It has been the MVP of the year 2022 so far. Let's hide that real quick so we can see what else is leading in the last few months. Well, the pink line here is the XLU, that is the utility sector, followed by we'll call that teal, the XLP, that is the consumer staples. And then right below, or a little bit below it, is red, which is the XLV, which is healthcare, followed by XLB, which is no, excuse me, XLI, which I believe is industrials. So those are definitively outperforming all the other stocks in the S&P 500 as of right now. And of course, our laggers, of course, down here, tech and consumer discretionary. We can see those in the troughs right here. There's an even better way to kind of visualize this, and that's using a tool from stockcharts.com. If you want to find this tool, here's the best way to do it. Stock Charts Sector ETFs. If you Google that, you're going to go down to this one where it says free charts, perf for performance charts, and it's going to take you to a page that looks like this. All right, so this right here is where we're going to really start to dig into this. Let's talk about theory. All right, here's the sector rotation model. And you can find this by Googling it, but I'm going to walk you through it because it took me a while to figure it out when I started trying to dig into it. All right, so the orange line that we have right here, that is the market cycle. In other words, when the orange line is high, that represents a market top, the top of the market, the all-time high, etc. And of course, when it's down in a trough right here, that represents a market bottom. And here you would see as the orange line rises, that is the market coming out of the bottom and going up into a bull market. And then as it rolls over the top, it goes into a bear market. Now, the stock market is, as they say, forward looking. In other words, it is trying to predict the business cycle, the economic cycle in advance. And so the blue line represents where the actual data actually is. In other words, are we in a bull market? a bullish economy? Are we in a recession? That is why the blue line is shifted a little bit forward. But we're going to focus on the market cycle because that's what's going to be most important to us as investors. So let's take some interpretations from this chart. At a market bottom, this is what we assume. We assume at a market bottom that technology, tech, and consumer discretionary, in other words, things that people don't need, but they buy when they want, those are the sectors that typically lead the stock market out of a bottom. Let's look at the chart up here. All right, so what we can do with this chart is really fun. We can punch in a number of days. I'm going to put in, let's say, 120, which is roughly 2 quarters. And then let's scroll this back until we can get to basically the March 25th, 2020. And we'll look at that quarter. In other words, this is 2020. The market bottomed on March the 23rd. What led us out? Well, we can see very clearly that tech, consumer discretionary, and communication services led us out. And if we go back down to our model, we see that tech, discretionary, and consumer services led us out of the bottom. The really key thing here is tech. We all know, we all remember that Microsoft, Netflix, uh, everything tech led the way out of the market bottom. And what I don't think people realized at the time was that this was entirely within the theory of sector rotation. So as the market begins to recover, what you should see is communication services and industrials and materials begin to start performing inside that bull market. So let's shift forward a little bit and see what happens. Tech continues to lead. It's like a horse race. There's our industrials and materials beginning to start to lead. And there they are there. And I remember very specifically in the end of 2020, energy began to lead. And here we run into the problem of expecting past results to guarantee future performance. This threw off the model. And a lot of people, including myself, began to wonder if the energy leading at the market top was beginning to give us a sign at the beginning of 2021. Well, instead, we actually got this second run in tech late into 2021 and consumer discretionary, throwing the model off. Oh well, I guess models are meant to be broken. But it did work for us out of the market bottom. Well, something interesting has happened since then. If we start to look now at the last 2 quarters, the last 120 trading days, or just 120 days, we now see something interesting. Of course, technology has been down, consumer discretionary has been down, but energy has led. But now we're starting to see a full model starting to play out. Consumer staples are leading, healthcare is leading, utilities are leading. And what these suggest is a market where the stock market is starting to roll over off of the highs. Why does money flow into energy at a top? Well, the theory behind that is as a market is bullish, as people are expecting a bullish market, they want to speculate that it's going to require more energy to run that market. And it's sort of the product of the optimism that has got the stock market up to where it is. Why then does it start to roll into consumer staples, healthcare, and utilities? These typically are value plays. Consumer staples are things like Procter and Gamble, Johnson and Johnson, things that people will always need to buy, like toilet paper, Coca-Cola, waste management. Those are two of my favorites from the last few months. And they're all consumer staples, things people will buy, recession or not. Utilities, people need the power, regardless of what the economy is doing. And all of these tend to pay a very good dividend. They become defensive plays when the market is starting to get a little bit shaky. and people aren't putting their money into growth and speculative or discretionary plays. That is the theory underpinning sector rotation and why we are seeing this value play come into the market right now over the last few months. People are getting defensive. They're putting their money in solid value companies that pay a little bit of a dividend rather than speculative assets. Now, if we take the model as a guideline and we try to extrapolate what should come next, and as a promise, that's what we're going to do. As the market begins to approach a bottom, as it begins to sort of round out its bottom, there are two sectors that should begin to outperform. That would be financials and real estate. Well, real estate has been doing very well. This is sort of experiencing a little bit of an outlier phenomenon. But over the last 120 days, there is a not quite the most of a loser, but there is definitely an underperforming sector in financials. If, big if, the sector rotation model plays out as the theory suggests, as it has shown evidence of doing in the last 2 years, the next sector that should see outperformance relative to the rest of the market should be the financial sector. That would, of course, be the XLF. So, what I would recommend people to do is be watching the XLF as a bellwether for the broader market. Right now, it's hanging around some lows, definitely not outperforming like some of the other sectors like energy, like XLE. But this in itself could actually potentially be a buying opportunity. I would like to see people look at stocks in the financial sector that they like. Look at JP Morgan. JP Morgan is fighting against these lows right here. We'll see what happens in the coming days. Bank of America is breaking some lows, not looking that great, but it's come back down to the July 21st July of last year low. And one of my favorite regional banks in the S&P 500 is Truist Financial Corporation, TFC. So all these look pretty darn bearish. But again, the sector rotation model suggests that these could be the next stocks to lead relative to everything else. So that is the high level view of sector rotation. And I hope this can be useful when you're trying to look for places to invest as this market cycle continues. As always, trade wisely. We'll see you in the next video.